Hey everyone, it's Nick with Us First Heard. Today we're going to go over things you should know before trading options on Robinhood. And I know that a lot of people that are commenting lately on some of my other videos are trading options without knowing what options are. If you don't know what an option is or an options contract, you should go look that up before making purchases. I'm getting comments saying people lost $6,000 in a week. Options is a good tool to use if you know how to use them, but it's also a super quick way to gamble and lose your money. So, when it comes to trading options, you have to be super careful. You have to know what you're doing. You can't just put money in and hope to get money out. But in this video, I hope to expose some of the risks of trading on Robinhood and to just kind of walk you through some of the things that I see that's kind of some of the things they do differently than other brokerages. Some of them are the same, but just so you kind of know what's going on here. And I'm looking at Robinhood's trading options page, and they explain it for the most part, but a lot of things they don't here. I won't go through all of this because I'm just going to go through the things that you should really know, because I think people are just confused. And one of the main things is called the break-even point. So if I go on to Robinhood and let's say I search. Let's do SPY. I'll be using them for an example today. And I go to trade. I go to options here. And as you can see here, there's something here called the break-even price. And how they calculate the break-even price here, it's the share price. This is the strike price, 268, plus the premium, which here is 78, so it's 268.78, so it needs to rise 0.5% about in order for you to, they say break even. However, so it's subjective. So they're saying the break even point is where the stock needs to trade at expiration for you to break even on your investment, taking into account the current value premium of the option. And take a look at this here, current value or premium of the option. And that's really subjective. You don't necessarily need it to go up to, let's say we were looking at this 268 call. You don't need to go up to 268.71 to break even. And that's why I say it's subjective. So if the stock price, there's a lot of things here. Let's go into here and just look at something called the Greeks. So there's something here called the Greeks. There's delta, there's theta, gamma, vega. All of these take part in pricing the option. Also, there's something here called implied volatility, IV rank. So the implied volatility, the higher it goes, the more expensive the option gets. And if IV and all these, so implied volatility or volatility in general, it contracts or it goes up and then it contracts. So it's subjective. So let's say I bought this call here, this 268 call. We're at 19%. Oh, see, it just changed down to 18%. Let's say the implied volatility was 18% now. And the price stayed the same, but then something happened in the market, and then the implied volatility went up to 30%. Added 10% on here. It's going to say my break-even price is going to be higher because the premium got more expensive. So implied volatility is going to make the premium more expensive for you to buy. So this call, the premium is going to go up. Even though I did nothing, the premium is going to go up, and even if the price stays the same. So if the implied volatility went up to 30% today, I'm going to be making money, and I probably would want to take the trade off if the IV goes up that much. Obviously, if the IV goes up that much, something's going to happen here to the stock price. But let's just say for grins. If I were to buy the IV rank, so there's IV rank and then there's the delta and there's theta. So let's say I bought this and it's expiration Friday. Today's Tuesday, and I buy this call here. Now it's at 64 cents. I buy the call. I hold it till Thursday. The price is at, let's say, about the same price. Let's say it's 267. See, it's down here. It's 266.90. Let's just say it's 267. So, I still need it to go up above 268 to get my strike price. However, the break even for me is I'm going to need it to go higher than I would on a Wednesday. So let's say, for instance, because of theta. So on Friday, expiration Friday, let's say the stock didn't move as 267. You know, this price is going to go out. You know, this might be 10 cents instead of the 64 cents. You know, let's say, and then you can go further out here. And you see how the prices are different here. $1.42 back on April 25th. Well, that's a different. Let's go back to 268 here. Come on, scroll. 268, 64 cents on April 25th. April 27th, we're at $1.22, $1.23. So, you know, the closer that you get to expiration, the theta is really going to eat down this option price. So, just because it's 64 cents today and the price of the stock doesn't move, theta is going to eat your option, mainly because the stock price has less of a chance of getting to your strike price, or this 268, the closer it gets to expiration. So, you know, they're saying here, you know, it's the percentage that you need to break even in your investment, but it also, that's at the time that you buy it. So the break even point is the time that you buy it. If you hold it, the break even point is going to change every day. It could change hourly. So don't get too hung up on the break even point or break even percentage is all I'm saying. You know, if you know how to trade options or you're learning how to trade options, don't get stuck on the break even point. Focus on the option price, how much time is left, and what the theta is, and what the IV is. If the IV is low, you know, buy. If it's high, sell. The other thing is, just like most other brokerages, Robinhood doesn't let you buy options on margin, so you can't have Robinhood Gold and, you know, buy $2,000 on margin. They just don't let you do that. Another thing here, people had questions about expiration and exercise. You know, those are a lot of questions that we get here. If we can click on this here. So a lot of the questions surround here, and actually Robinhood has a page about this. What happens when your option expires? Some people were asking me questions. Can I sell it before expiration? Yes, you can sell the option at any point before expiration if it has value, of course. If there's a buyer for your option, you can sell it. You know, that being said, if you bought stock, it drops super low and there's no buyers for it, obviously you can't sell it. But if there's a buyer for your option, you can obviously sell it at any time. It depends if you want to take the gain or take the loss at that point in time. You know, it depends on how much time you have, and you can, you know, I always recommend having a plan before you purchase options. Just like stock trading. What's your plan to get in? What's your plan to get out if it doesn't work? Or what's your plan to get out if it does work? One important thing here that Robinhood does differently than other brokers is right here. We won't allow you to open a position the day the contract expires. All contracts are set to position closing status the day before expiration. So that's kind of hard for me to do because a lot of times I do trade stocks, I do trade contracts that expire on the day of expiration. I flip them quick. You know, there could be like 10-minute holds, 20-minute holds, 30-minute holds. I don't hold them for very long. And it's kind of sad that Robinhood doesn't do that, but I understand why they don't do that. And I actually have a screenshot here of a call bought the other day. But if you look down here, there's a disclaimer that says this option expires today, so you can't buy additional contracts. If you don't have enough buying power or to exercise, we'll sell your contract about an hour before close. And the reason why Robinhood does this is because of risk. They know a lot of the people that are trading options on Robinhood have never traded options before, and it's all about exposing the brokerage's risk. They don't want to take on too much risk. So if you look at like SPY, there's a lot of expirations, but they don't let you trade on expiration day. You can only sell, if you have options expiring on the day of expiration, you can only sell it. Also, if you don't have enough money in your account to exercise the option at the expiration, they will sell it before 1 hour before close at the market for you. And the thing is, you don't want it to get in their hands, because when you put it into Robinhood's hands or any brokerage's hands, when they sell the option for you or make choices on your account on your behalf, they're not going to give you the best price. They're not going to give you the price that's going to be the best for you. They're going to do the best what's best for the brokerage, what allows them to reduce the risk on the brokerage's behalf. They don't want to incur risk on your behalf. So they'll do whatever they can to get out of the position or reduce the risk on their behalf. Whether you win or you lose money on that trade, they don't care. It's all about the brokerage. So just keep that in mind. If you're trading options and it's in the money, you need to sell it before expiration, because I'm guessing most of you don't have the money to buy 100 shares of Twitter, 100 shares of Apple if you're trading stock. So for every contract, you have to buy 100 shares. Just keep that in mind. So they're saying you don't have sufficient buying power. Robinhood will automatically exercise it for you at expiration unless doing so will result in a short stock position. So they won't do it if you're going to have a short position on the stock. If you have a long call, let's see here. If you have a long call, if the contract is that the money will assess your account, look at here, they'll say, we'll assess your account to see if you have enough cash to buy the share. So when they're assessing, they're seeing if you have the money, what's the risk if you hold, what's the risk if you don't hold. And so they're going to be constantly monitoring your account to see if you're a risk to the brokerage. So just keep that in mind when you're trading options. And those are really the basic ones that I wanted to go over. Exercise, you can't buy and sell on expiration day, which for like things that expire 3 times a week, like SPY or QQQ. I'm sorry, QQQ only is once a week, but SPY, you can trade that Monday, Wednesday, and Friday expiration. But here you can't trade on that day, so you'd have to open the position a day before or before if you wanted to trade it or sell it on that day. So I definitely suggest going through their options FAQ just so you can understand. I pretty much walk through all the risk or anything that I think that should be brought up. The rest you should definitely study on your own. Get to know options before trading it. And if you are starting to learn trade small stocks like Snap or Twitter, and don't put a lot of money in. Only trade like $30, $50 at a time. Don't put thousands of dollars at risk because you'll make it big. Maybe you'll hit a jackpot, but probably not. You'll eventually lose it all if you lotto play like that. So do your homework. If you have any questions, definitely leave a comment below. I'd love to answer it. First time coming across this channel, like and definitely subscribe to this channel.